This market feels stressful to some people and strategic to others. Same rates, same headlines, same economy, different balance sheets. Let that land. And that difference is why some people feel trapped, while others feel opportunistic. If you've been quietly thinking, I don't know if I'm missing something, you're not crazy. You're in the middle of a separation cycle. This isn't about hype. This isn't about fear. This is about structure. Today, we're breaking down what actually changed, where leverage is forming, where it's disappearing, how liquidity behaves differently than leverage, and what capital-sensitive markets are revealing about 2026. Nationally first. Then we'll use one of the most capital-sensitive markets in the country as a case study. No drama. Just positioning. If this kind of structural housing breakdown helps you think clearly, please subscribe. We build these frameworks layer by layer. In 2021, debt was cheap. Momentum validated decisions. Leverage was rewarded. In 2026, debt is expensive. Insurance is real. Liquidity matters again. It matters. Time on the market matters again. Let's model this. Mid-tier national example, 650,000 purchase, 20% down, 520,000 loan. At 3%, about 2,200 per month, principal and interest. At 7%, about 3,450. That's roughly $1,250 per month difference. $15,000 per year. Now layer in property tax, maybe $700 a month insurance, $250 to $600 depending on region. Your cost stack shifts meaningfully. That's structural separation. Upper tier, 1.4 million purchase, 1.12 loan, 3%, around $4,750. At 7%, around $7,450. That's $2,700 per month difference. Over $32,000 per year. Add taxes, add insurance. Total housing stack, $9,500 to $11,000 per month. That changes psychology. And when payment controls psychology, leverage controls behavior. Liquidity doesn't Feel that. Liquidity evaluates spread. That's the separation. Most people watching fall into one of three categories. Type 1, payment sensitive. Housing near tolerance. Vulnerable to insurance spikes. HOA increases. Repairs. Income shifts. This person says, it just feels wrong. That isn't irrational. That's structural stress. Type 2, liquidity strong. Cash on conservative leverage. Concerned with entry efficiency. Negotiation windows. Long-term positioning. Exit demand. This person asks, where is the inefficiency? Same market, different experience. Type 3, strong income, moderate, liquidity, cautious but analytical, wins by modeling, 5 to 7 year hold minimum, usually, insurance variability, maintenance reserves, hopefully, exit buyer profile. If you're modeling seriously right now, comment structure. This is not hype, but structure. This is not a Florida-only story. Markets that accelerated fastest are repricing fastest. Stable employment markets normalize slowly. New construction, those corridors are incentivized quietly. Condo markets are bifurcating. Well-funded associations, underfunded associations. Reserve strength, it matters. Insurance exposure matters. HOA governance matters. This is mechanical. It's not emotional. The market isn't good or bad. It's selective. Selective markets reward preparation. Preparation replaces comfort. If this framework sharpens how you think, hit the like button. It tells the algorithm serious housing breakdowns should reach serious viewers. +45 days on the market. Let's talk about 21 to 2022. Let's call assessment for condos zones. Payment sensitive, price bands, insurance, exposed corridors. Let's give an example. 1.45 million listing. 52 days. Then to 1.35 negotiated to or 1.32. In 2021, that conversation did not happen. Spread returned. Spread is where professionals live. If rates drop significantly, demand compresses fast. Unleveraged windows close. Timing risk matters. Sorry about that. I'm getting better, but you know. And it's not because it's Florida's story, but because capital sensitive markets reveal shifts early. Palm Beach County is not one market. Palm Beach is not Jupiter. Jupiter is not Boca. Boca is not West Palm. Condos are not single family. Segmentation widens in leverage cycles. Luxury tier, 3 million plus. Cash heavy, liquidity driven, selective. And 8.5 million waterfront closes at 7.9. Insurance, 60,000 per year. Liquidity absorbs. Negotiation, quiet, not dramatic. Mid-tier, 1 to 2 million. Rate sensitive. Insurance sensitive. Days on market, extended. Concessions, return. Inspection, leverage returns. Normalization, not collapse. Condo tier. Reserve compliance. Special assessments. Insurance. Repricing. 25,000 assessment hits. If liquidity thin, they sell. Inventory rises selectively. Mechanical adjustments. Not panic. Palm Beach signals. Days on market. Reduction. Frequency. Insurance variability. HOA reserves. Relocation flow. If you're in Palm Beach County, the Gardens, Boca, Jupiter, the island, drop your area below. Now, the real question, what do you do? If you're payment sensitive, keep housing under 28 to 30% gross income. Stress test insurance plus 10%. Maintain 6 to 12 months liquidity. Avoid short hold assumptions. If the numbers only work best case, they don't work. If your liquidity is strong, target time on market, leverage, negotiate, quietly model exit, demand, evaluate insurance before contract, avoid emotional bidding. If you're selling, price for today's pool, compete against active inventory. Remove the friction. Don't anchor 2021 memory though. If you're relocating, Model cost stacks insurance. HOA governance, exit demand. Relocation is capital allocation, not just lifestyle. Sorry, my voice is really giving out me. I'm sorry about that, guys. If you watched the previous breakdowns on the discomfort, today was the structural layer. Stress doesn't always mean danger. Sometimes it means filtration. Same market, same data, different outcomes. Clarity compounds, and I will keep saying that. Confusion compounds too. Choose carefully. Remember, I'm your favorite South Florida real estate agent. I'll talk to you tomorrow.